All right, everyone, quick market check. The Fed cut rates, inflation barely budged, mortgage rates eased, and now we've got a government shutdown thrown into this crazy mix. So what does all that really mean for your buyers, your listings, and your closings? Let's break down what happened over the past month and really what's coming next. So September gave us a little bit of breathing room. For the first time in months, mortgage rates dropped into the low sixes, and they're hovering around 6.3 to 6.4%. The Federal Reserve cut its Fed fund rate by 0.25% on September 17th. So this is the first move in months towards easier policy, and their message was really simple. The economy's cooling, but inflation really still needs work. And we've seen buyers start trickling back in. We even saw pending home sales jump about 4% month over month, which tells us buyers are paying pretty close attention when rates move, even just a little bit. Now, here's what really moved rates. So inflation, the August CPI came in at 0.4 positive month over month and about 2.9 year over year. So that's a little bit higher. The core PCE, which is the Fed's preferred measure, landed at 2.9% as well. So that's progress, but it's really not victory. Prices are easing a little bit, but slowly. And keep in mind, this is not deflation by any means, but it means inflation's coming down a little bit. So the August jobs report also was a big miss, only 22,000 jobs added, way below expectations. And that's a big signal that hiring is slowing down, which is actually what the Fed wants to see. Consumer confidence also took a dip, and the New York Fed's consumer survey showed that people are more worried about the job market and expect slightly higher inflation over the next year. So when you combine weaker job growth, easing inflation, that's really the recipe for lower rates down the road. So that's positive. But the Fed's still pretty cautious. They don't want to cut too quickly and possibly reignite inflation. So they're in this weird middle ground. So what's happening on the ground? Mortgage demand has actually started to rebound. The MBA reported rates hit an 11-month low early in September, which is amazing. And both purchase and refinance applications ended up ticking up. According to Freddie Mac, last week's 30-year fixed rate average was 6.34%. Keep in mind that's an average, not the median. So that's almost a full point lower than earlier this summer. And buyers are re-engaging. We're not in a boom, but there's a clear shift in the tone. And people are back to asking, what can I qualify for, instead of, should I even bother right now? Now let's talk the government shutdown, right? Big topic right now. It's not catastrophic, but it does slow a few things down. So FHA and VA are still open, but with reduced staffing. So expect maybe some processing delays. USDA loans are the biggest concern. So no new guarantees can be issued during the shutdown. If your file already has a conditional commitment, you can still close, but the lender takes the risk. So basically no new USDAs, those are basically on pause. The IRS and Social Security Administration verifications might lag, which means slower underwriting. And the big one is flood insurance under the NFIP program. They can't issue new policies while funding is paused. So that could totally stall closings in flood zones. Conventional loans through Fannie and Freddie are fully operational, so no issues there. Bottom line, most loans will still close, but timelines do matter. So agents, this is a good time to maybe pad your contracts by a few extra days and double check the flood coverage early, like really early. So where are we headed next? Most forecasts from Freddie, Fannie, MBA, they show rates hovering in the low to mid sixes for the rest of the year. Now, if inflation keeps cooling and job growth stays weak, we could honestly see rates maybe touch 6% or hopefully even the high fives by sometime in 2026. Let's say some prayers this is true. But remember, stability is just as powerful as a drop. And when buyers know what to expect, confidence returns at that point. You know, there's up and down, they don't like it. So that's the pulse of the market. Steadying rates, cautious optimism, a few speed bumps with the shutdown. But as always, stay sharp and informed and keep moving forward. And I'm Brian Marks. Follow me for more info.